Hello, my name is Daniel Vasquez. I'm an owner and managing partner of Ophir Financial. Ophir is spelled O-P-H-I-R, Financial. This presentation is primarily designed for individuals that are looking at wealth building, financial planning, using property in this particular case. Not all individuals develop their wealth through the property side, but in this particular presentation, is for those of you that are looking at doing exactly that. As you can see, we start off by, in the yellow printed, is planning, protection, increase, and management. That's the scope of the additional services that we're starting to provide our clientele. Again, Ophir Financial started 3 years ago in the mortgage industry. One of the things we found is our clientele are not necessarily using their property as efficiently as they could have to help them build their wealth at this point. Some of you are starting to get the idea and understand how that can be a major benefit to you. So we talk about planning right in the beginning. We help families plan their financial stability. I use the word stability because the programs that we put together and the financial instruments that increase interest gain, if you will, are low risk and medium yield type of programs, rather than going out to a high yield, high risk side of it. That's why we focus on the stability. In addition, one of the things that we had to focus on right away with our clientele is with financial instruments, we help protect themselves or protect the family from loss. A loss of life, of course, and that, of course, loses one of the most important assets that a family has, and that's their income. So an income loss is an important asset. Therefore, we build through these financial instruments a way to actually have that additional funds available to you so you can get back in stride if for some reason you lose your income potential. Now, the other part that we focus on is also the increase in interest gain, if you will, and the tools that we use. All investments must create interest gain using compound interest and arbitrage. Compound interest meaning the idea that you're taking an interest, you're incorporating it into the balance, you're compounding that. In this particular case, you'll notice that our instruments will compound. It's actually triple compound. I'll explain that down the road. Arbitrage is what property does, taking the same investment, and it creates over a period of time a higher yield. It starts at this, it yields at this. That's arbitrage. In between there is arbitrage. We won't get into the concepts too much on the financial side at this point, but that's what we mean by arbitrage. Now, management. In financial planning and wealth building, one of the things that's important is to have the family know where they stand at a particular time, even every 6 months, or if need be, every month in the beginning of where they stand with their investment side of things, or investment and where they stand with some of their assets, especially their income side of it. We have families that will call because they're in this position right at this point that, one, they've lost their income and they don't have this relief that from the government, as an example. And yet they had a policy or a financial tool as an annuity, etc., that we can create a settlement offer or that type of thing to actually protect their income until they get working again. So those are the types of things that we do. We're going to start into this presentation in this next slide. In this next slide, same type of thing, is that we're going to see this green block, as you can see, coming up here on the bottom left. And this is the first start of the planning process. We take a look at the family's assets that are available to them and potentially available to them in the future. Their assets, their income stream, life insurance, property, and etc. I should have put etc. there. There's a number of different things that you can invest in to help you from the beginning of your working years to the end of your working years. And as you can see, we put a yellow line from left to right in an increase. This showing the increase of value in the investments that you make and how we get to what we call the end of the working years. Now you can see there's a green button on that yellow line, dotted line, and that's kind of starts the process of your family income. One of the most important assets in financial planning and wealth building is not just protecting that asset, but it's protecting your income. Income is an asset. As a strategic planner over the years for AT&T and some major companies for their small businesses, one of the things I realized in a small business is that their revenue stream became really important to how do they divide it up into here's what we need for the production side of our business, our operational side, but we also need some of that profit at this point for growth, developing new tools, new investment in a number of different things, even personnel. Those are things that you invest in that one allow you to create more revenue. The same thing applies in a family, and we call that functional or income function. The income function is an asset. We look at it in that fashion as financial planners for a family. In other words, that asset needs to continue to flow as best you can. If not, we have to use those investments at this point to help you do that, as well as that financial instrument. So we know that that income function has to be spread out, just like a business. The family business needs to consider the operational budget. This is how we operate as a family. Even the things that help you take some time off, like vacations and those types of things, and things you need for your children, as well as, you know, just payments on your first house, those type of things. That's the operational budget of a family. Now, we also need to consider the fact that that income function, you also need to save some money for not just at the end of your working years, but also how do we improve our wealth position. And this is what some of you that are thinking in the property side are starting to think very much on the idea, well, how do we use the property to actually create that wealth? And what we're doing is bringing an instrument in to help you save that money so you can maintain the value of those investments. So in addition to that, since we're talking about the start of your working years to the end of the working years, ultimately that is what we're trying to help you with. Not just your investments here, but all the way out, what's going to happen to you at the back end of this thing. And we use two terms, liquidity and legacy. Liquidity is we need to help you understand through the management side of these tools that you're purchasing. This is the liquidity that you will have at the end of your working years. So we bring reports to tell you that, well, you're 80% on target, 100% on target of what you want to accomplish at the end of your working years. And what we mean by that is that, one, most people, when they get to that point, don't have the similar income that they're used to, the similar lifestyle that they had as they were growing when they get to the end of their working years. So that understanding that liquidity is a real important part of it to say, well, okay, here's your investments. When you get to the end of the period of your working years, this is how and what we're going to do. This is how we move it. This is what we put it in. This is what your income is going to be. And it's real similar to your lifestyle as you're used to. Okay. Now, I'm going to put some other buttons in that yellow arrow line. And the first green thing is your first home. The first home is probably the largest debt that you create, but at the same time can be the most important, valuable asset that you actually have. As I mentioned early in this presentation, we started 3 years ago in the mortgage industry, and we started incorporating that into Sphere Financial. But we started to realize that individuals really didn't see the power of that value of that first property. And some of you are starting to catch that idea and understand how that flow can actually make a difference to you at the end of your working years as far as investments are concerned. So that first home is something we need to consider and help you manage. Now, what we don't suggest is taking all of that equity and put it into a financial instrument that we're going to be talking about. But we'll get into that in a little bit. Now, the next thing that we're going to talk about is your second income property. Those of you, and this presentation is for those of you that are thinking in this process. And we're just putting down second income, maybe third or et cetera. Most people look at a second income just to create income. But the real value of that property is the equity over the years that you have it. However, that second income does create an income for you, therefore it's a taxable in a lot of cases. If you have too many income properties, that tax burden can be pretty high. However, in the second income, one of the things that's important as an investment, since it's going to create this tremendous yield of liquidity as well as profit, is that one, when you have a property and you're creating that equity in there, you realize that the value of that property after you have a second, third lease on it, you need to upgrade. You need to upgrade the property as far as maybe the grass is going bad, you need to repaint it, you need to fix some of the walls and all the other things that go along with renting a property at this point. And it can be fairly expensive at the end of that time frame. And you need to spend that money in order to maintain the value of this instrument or this investment. It's one of the investments that's a great investment, but it's one investment that requires maintenance. Maintenance meaning you have to maintain the value of that. In stocks and bonds and CDs, basically that's an instrument that you invest in at this point, and basically it just takes some cash to keep that rolling in there. But you don't have to maintain the value. The value of it is all it is. In real estate, you have to maintain the value to the rest of the comps or the rest of the things that are around it, things meaning property. Now, I'm going to continue on with some of the other investments, though we're talking about property. What we always think about, even though people are in property, is that there are other investments that they can make as well. And those are qualified programs, 401ks, IRAs, etc. Although we have to consider the burdens, again, as I said in a top end there, the end of your working years. They all have different tax burdens or different fees involved that you have to consider when you start thinking of the liquidity of that. And property is fundamentally, it has the same issues, but we have to think about how do we create the liquidity out of those properties at the end of the working years. And those tools are available through us. Now, there are other assets such as metals, precious metals, stocks, etc., that people invest in, and we consider those if individuals are interested in those. But we only consider them to the point of here's your starting, here's your end of your working years, and here's what's going to happen with the liquidity process. So we have to measure all of those things up in order to say, well, you're 80, 90% on your way to your same lifestyle at the end of your working years. So this is holistic. This is the process of that entire thing of from point A to point B. Well, we're going to start talking about how do we work with the property investments that you have. Now we're going to throw in this presentation a financial instrument to increase that increases in wealth. Okay, so it creates its own increase in interest. Now in this next slide, I'm going to take out some of the blocks here just to make room for this presentation. And there should be an arrow coming up here that right there that starts to point down to the financial instrument that we're talking about that will help you maintain the value of those properties that I put in red up here. Okay, that financial instrument, you'll notice this thing coming up, which is a life policy. That life policy, we use a whole life policy. We also use annuities in this same sense, although they're a little more clumsy in the process, and we'll explain that. But the ones that we've selected as being the best tool to use is that whole life policy. Now that whole life policy is sometimes misunderstood as what you can do with it, and that's what we're trying to accomplish here. There are a number of provisions inside this whole life policy that will allow us to do things real similar to a banking concept. Not using a banking concept, just identifying it from the characteristics that it has, the provisions that is. Now the green lines, arrows that I'm putting up here now in this presentation is the premiums that you're putting into that whole life policy, which will create value there. But I call them something different on purpose, and I call them operating expenses. Because one of the things I learned as a strategic planner in the business environment is that, one, they always had to consider growth in their budget. In other words, what was the expenses that we had to create to improve our equipment, to improve our personnel, to improve all those things that creates more value in our business. And we call those things operating expenses. Came out of the profit, but that's what we did. We used different tools in some cases and investments to actually create that opportunity expense. And we actually put it in to building more revenue. The same thing applies here with this tool for a family. We call it operating expenses, the premiums. But something happens that's very valuable in this whole life policy is, one, as you put the premiums in, you are creating a cash value inside this tool. It is also protecting you because it's an insurance policy. And we consider that along with maybe a term policy to actually get you where you're going. So we do what they call a blend. But we use this tool specifically for the cash value and the dividends that it creates. The reason I'm saying dividends, I should explain that the carriers that we use are mutual companies. What that means is that when you invest in that policy, you become an owner in the company. So not only do you own the policy, but you also are an owner in the company. Therefore, as an owner, when there's profit in the company, you receive a dividend of increase, the same as you would in any other type of profit-making organization. In this particular case, it's your business in a whole life policy that is creating that dividend. That dividend is coming into you and it's compounding as well. So they're taking the dividend, they're putting it into the whole life policy as what they call paid up additions. We can talk about that down the road, how that actually is handled. But those dividends are inside your policy at this point, creating compound interest using general terms. Now, I put up here using a bank concept. What I mean by using a bank concept is that this tool, though sometimes misunderstood, they're really not considering some of the other provisions involved with this tool. It has the same characteristics as a bank. You can deposit money into those premiums you're depositing into, and because they're cash value and dividends, you have access to them. So they're available to you so you can withdraw that money at any time, okay, depending on the policy of when you can take it out, okay, but it is available to you. Saving money long term, the whole life policy is primarily designed to help you save money all the way from the beginning of the working years to the end of the working years and actually create an income out of it. And that tool is the one that we're using to create a turnkey process for you, okay? Now, invest in their services. In a bank, you can invest in their CDs and their bonds, and those types of things. And in the whole life policy, you can do fundamentally the same thing. You can take a whole life policy, you can take a term policy as an example, if we add it to this, and you can add another whole life policy to this process as you grow. Not singly right now for your property, but as you grow, you may want another whole life policy to take care of some other expenses. That's entirely up to you, and as we start to grow this thing. Now, one of the features in here that's important in this process is the borrowing money feature of a banking concept. You can borrow money. Now, I'm going to put up here something that's really important that you want to focus on, is the insurance company. Now, if I call them carriers, there are carriers of the policies and the products, but if I say carriers, it means the insurance company. Now, there's something different in this borrowing process that's important and really important to understand, is that you borrow money at a lower rate than the cash value and dividend increase that you have in the whole life policy. You borrow money, and notice in the orange down here is from the insurance company, not the policy. That's a critical point, is you're borrowing money from the insurance company, not the policy. So that policy continues to compound in interest, compound the cash value, the dividends, etc. You want it to continue. So you're borrowing money only through, hold for a second, let me catch up here. In this next slide, you'll start to see that the dividend and what we're doing is that, and cash value, what we're doing is we're going to put it into this policy, and we're going to use it, as we said in the last slide, that we're going to take it from the banking system. Again, the banking concept and borrowing concept is in the insurance company, the carrier. So what's going to happen in this presentation, as it comes up, you'll see a green arrow there. That represents the idea that you're borrowing money and you're putting it into the property side of it, and then you're putting back. You'll notice I put a circle around the second income property and the first home that you have, because if you're going to borrow money, you want those properties, mostly your second income property, to start giving you the opportunity to pay those premiums back. Remember the premiums down here in opportunity expenses? Well, we're going to take and have your second property start to pay those things off. So we're going to create a turnkey environment. Well, let's go back and keep in mind the reason you're doing this is because that second property, as well as your first home, but your second property needs to maintain its value in the marketplace, and that takes money to do so. Now you can take that money out of your income and out of your operating expense and put it in there, and you get your home upgraded at this point. Could be $6,000 to $10,000 depending on the home. And what happens is that that money is spent. You don't have access to that money again. That's one of the things we're trying to accomplish, is since you can return this from the property side, the property gives you the value back into your insurance company to pay that back, which maintains the value in your life policy. I know that sounds complex, not as complex as you. Now in this next slide, you'll see that I'm going to start creating what I call the turnkey environment. The turnkey environment is taking, you'll notice that I put up here on the property side, I put 1 numbered at number 1. Number 2 is the whole life policy. 3 is the insurance company, and it's going to create a continual turnkey process. Okay. Now, in this process, just taking it a step at a time, looking at a step 1, just as an example. Now, this is just an example with these numbers. We have to go through somewhat of an analysis to determine how you're going to do this. Step 1 is determine what the expense level of upkeep of the property will be. Let us say $10,000, that this home is at the end of a year or 2-year period of time is going to cost you $10,000 in order to get it back up to market level. Okay. Step 2 is purchase a whole life policy for $10,000 annual premium. Wow, where do you get the $10,000 in your case? It's the home, your first home, maybe even your second home if you have one. You have 90% of the cash value and dividends in your whole life available at the end of a year's period of time. Dividends may not take place till the end of the second or third year, but that cash value is always available to you. That cash value that you put in is $10,000, and the $10,000 is available to you at 90% in those first few years. Step 3, close to the end, should put close to the end of year 1, use your second income property to pay back your whole life long-term investment, your whole life policy, that is. Okay. Loans pay back equaling $10,000 premium. Remember, you still have a premium every year of the $10,000 that you need to put into that whole life policy, which goes into your savings program, which compounds from the beginning of the working years to the end of the working years. So that money isn't going away. So you're taking that $10,000 premium, but you also have $10,000 that you borrowed possibly. So you have $10,000. The total home equity loan on the income property is $20,000. So what you're doing is you're borrowing it from your second property or your first property, depending on which is more efficient. And you're taking that and you're putting it back into your pool of money, which is in the whole life policy. Because you have put in not just what you borrowed, but also your premium, or your premium first and then what you borrowed, you're going to create a turnkey system now, because now you always have money available for that property. You always have money for that property, and you always have money to pay that premium. Now, step number 4, this will create the turnkey system, as I just mentioned. In addition, procedurally, keep the money, more money in your pool of money. What I mean by that is that the money is staying in your system. Probably the best way to explain that is that if you spend money out of your own budget, your operational budget for those properties, you don't have the opportunity to compound that money. Somebody else does because you spend it. What we're trying to do in this turnkey system is keep that value of money back into your policy at this point because you're increasing in value. Okay. Again, all the tools that we use always increase in value, in interest value, and interest gain. So what we have here is the concept. This was the objective. There's other questions you may have, and we're willing to answer every question you may have. This is not a new concept, but it is something that should be explained, that it is of value and has been of value to many, many people, especially people that have become wealthy. They use this concept all the time.